Hello, welcome back to Chapter 6 and Merchandising. In the previous lesson we talked a little bit about some of the new accounts that we use in a merchandising concern. I think a couple of the exercises in the textbook would provide some good practice using these accounts. If we were to take a look at exercises 6-13 and 6-14 on pages 289 and 290. It's a relatively short exercise, and hopefully we can get it done in the allotted time here. Basically requiring some journal entries for these merchandising transactions. In exercise 13, actually the transactions are presented, and exercise 14 says to go ahead and prepare the journal entries. So we're kind of combining those two, and let's focus on the journal entries. So at the bottom of page 289, exercise E-613. The following transactions were selected from among those completed by Bears Retail Store in 2010. On November 20th, sold 2 items of merchandise to Cheryl Jan, who paid the $400 sales price in cash. The goods cost Bears $300. So we have actually kind of a two-sided transaction. We have a transaction that actually affects 4 different accounts. The first part of the transaction would require us to record the sale itself, and then the second part of the transaction requires us to record the cost of that sale. So focusing first on the sale amount, and I just will list the transactions one at a time. First on November 20th, and we have a debit to cash, since they made the sale for cash. So we're going to add to cash, and the amount of the sale, the amount collected, was $400. In our credit, we're going to increase cash, which is an asset, and over on the right side we're going to increase a revenue account with a credit. And so our credit will go to a revenue account, and let's just use the account sales, and that credit amount is $400. Now for merchandising, and this company uses the perpetual inventory system. We need to record the cost of sale for each sale made. And so the information in the transaction gives it to us. The cost of this sale was $300. And so cost of goods sold is recorded as an expense over on the right side of the equation. And if you recall from the previous lesson, that inventory is sitting in an asset account called merchandise inventory. And so when we sell inventory, we need to show that the inventory account has been reduced. And so the way we would do that is with a debit to the account cost of sales in the amount of $300. And our merchandise inventory account, which is an asset account, will be credited in the amount of $300. So what this sale is providing us with in terms of a gross profit would be the revenue amount in the account sales of $400 less the expense amount in the account cost of sales of $300, or a gross profit of $100. Okay, second transaction on November 25th. Sold 20 items of merchandise to Vasco Athletics at a selling price of $4,000, and that's the total price. On terms 310 net 30. The goods cost bears $2,500. So again, this is a sale, again, as in the first transaction, except this sale is not for cash. And we know that because the terms of the sale are given. 3% 10 net 30 would indicate to us that it's a credit sale. So the customer, Vasco Athletics, has the option of taking a 3% discount if they pay within 10 days of the invoice date. Otherwise, the full amount would be due in 30 days from invoice date. So, how do we record this transaction? Date is the 25th, and it's going to be similar to the first transaction, two-part transaction, except that we are not receiving cash. We are receiving our customer's promise to pay. So we end up with an account receivable on this transaction for the total sales amount of $4,000. And of course, our revenue will be recorded as we did in the first transaction with a credit to sales, also in the amount of $4,000. Now we need to, as we did in the first transaction, we need to record the cost of that sale, and it's given to us in the problem. So we need a debit to the expense account, cost of sales, and the cost of that sale is $2,500. With an offsetting credit, again as we did in the first transaction, to our asset account, merchandise inventory, to show that our asset has been reduced because we have sold inventory. And that amount is $2,500. Again, in this transaction, we end up with sales revenue of $4,000 less an expense, cost of goods sold of $2,500. So this transaction is providing us gross profit of $1,500. Okay, on November 28th, in this transaction we sold again identical items of merchandise to Nancy's Gym at a selling price of $6,000. Terms 310 net 30. Cost of the goods cost bears $4,000. Now this transaction is basically the same as the one we just recorded. So I'm just going to write those accounts in quickly. On the 28th, and we have a debit. This is a transaction to a different customer. A debit to accounts receivable, and that sale amount is for $6,000. And a credit to sales for $6,000 to record the sale, and then we record the cost of goods sold or cost of sales with a debit to cost of sales, and the cost of that sale was $4,000 with an offsetting credit to the merchandise inventory account of $4,000. So again, this transaction almost identical to the previous transaction except for the amounts. Two-part transaction. record the sale first and follow that up with recording the cost of that sale. Okay, let's go on to the next sheet here. On November 29th, Nancy's Gym, again, we made this sale to Nancy's Gym on the 28th. Was a $6,000 sale, and we had sold 10 items. The sale amount was $6,000, and the cost of that sale was $4,000 for 10 items. So on the 29th, what's happening? Nancy's Gym returned one of the items purchased on the 28th. The item was in perfect condition and a credit was given to the customer. So we need to first calculate the sale amount and also the cost of one of those items sold. And so let's just show that here. The sale amount was $6,000 and the cost of sale was $4,000. We sold 10 of those items, and so the selling price of one of those items was $600, and the cost of one of those items was $400. And so the unit amount in this transaction is what we need to record, because one of the items from the 28th, the sale on the 28th, was returned. And so which accounts do we use? We're not going to reduce the sale amount. Rather, we use that contra revenue account that we talked about in the previous lesson. And that contra revenue account is our sales, returns, and allowances account. So we will debit sales, returns, and allowances for the amount of one item returned at the selling price. And the transaction says that credit was given to the customer, and so since that sale was made on credit and we had added the total sale amount to accounts receivable, we need to show that the accounts receivable from Nancy's Gym will be reduced because of this return, $600. Now, as you recall, when we recorded the sale, we recorded both the sale and the cost of the sale. Now, we are receiving that inventory item back, and the transaction says that it's in perfect condition. So what that tells us is that we're going to put it right back into our inventory. And so the second part of our transaction would be to debit merchandise inventory for the unit cost of that item, which was $400. And our credit would be to reduce our cost of sales account by one item, $400. So again, another two-part transaction. Basically reversing the transaction from the 28th for one item. But again, instead of decreasing the sales account with a debit, we use this contra revenue account, sales, returns, and allowances, and that's where our debit ends up in this type of transaction. Okay, let's see. On December 6th, on December 6th, Nancy's Gym paid the account balance in full. Okay, so Nancy's Gym is going to pay us off in full. We need to calculate how much they owe us. And so again, going back to that transaction, the transaction was on the sale was on November 28th, and that was for $6,000. And then on the 29th, there was a return of one item, $600. And as you recall from the transaction, we didn't write it on the journal entry, but the transaction indicated that it was a credit sale, and there was a 3% discount if paid within 10 days. And if we go back to the 28th and count forward, we would have 2 days to the 30th, and then another 6 days in December. We're in the 8th day, which is within the 10-day period. And so the customer, Nancy's Gym, is entitled to the 3% discount. And so that discount is calculated on the net amount, net of the return on the following day. And so we need to show that discount calculation, 5,400 times 3%. And that's $162. This is the discount percentage, and this is the discount amount. So what will the payment be? The payment will basically be $5,400 less discount of $162, $52.38. Will be the cash payment net of discount, $52.38. So we need to record that journal entry. First of all, we are receiving cash, and as we just calculated on the previous page, the cash amount to be received is $5,238. Now keep in mind, the account receivable is this $5,400. When we made the sale on the 28th, we added $6,000 to accounts receivable. And then when we made the when we recorded the entry for the return a day later, we credited accounts receivable for $600. We gave the customer full credit for that one item returned. And so the amount that they show as owing to us before the discount is $5,400. And so that's the amount we need to credit on this journal entry. Credit to accounts receivable of the full $5,400. And we need a debit amount to balance this entry, and if we were to calculate the amount of the debit that we need, we would see that it's $162. And that should look and sound familiar, and it is, because That's our calculated cash discount, the 3% cash discount. So our debit is to the contra revenue account, sales discount. And that would be the journal entry to show the collection of the entire account balance from Nancy's Gym. Now we have one more transaction to record on December 30th. Our other customer, Vasco Athletics, paid in full for the invoice of November 25th. Now, November 25th invoice also was on account, also included terms of 3% 10, net 30. The invoice was dated 11/25, and we are collecting on December 30th, and so this is well outside of the discount period. In fact, it's even a few days longer than 30 days. And so for this account, the entire amount with no discount will be collected. And so we will, I need to show the date here. This was on the 6th. And then the last transaction is on the 30th. And so that account balance for Vasco Athletics is the full amount of $4,000. Let's go back once more to that transaction. We can see on the 25th, our debit to accounts receivable for the sale was $4,000. So we are going to collect $4,000 debit cash for that amount and credit accounts receivable for Vasco Athletics in the amount of $4,000. And that would be it in terms of the journal entries for these exercises. We went a bit over our time allocation. I want to thank you for your attention. I hope this was helpful. Thank you.